what I purchased during the day is goods available for sale during the day. In terms of my cost, I spent $2 for what I began the day with. I spent $4 for what I bought today. So my goods available for sale at cost, 2 plus 4 equals 6. At retail, so that's the marked price, what I expect to receive for it when I sell it. For the item in inventory at the beginning of the day, 4. For the additional item that I purchased today, 8. Total goods available for sale valued at retail, 4 plus 8, or 12. Well, that means that when I look at the goods that are available for sale today, if the two of them cost me $6 to buy to begin with, that's cost of 6. But I expect to sell them at a combined value of 12. Then cost as a percent of retail, or cost divided by retail, is 50%. Now then there's a second step. If the two goods have a retail value combined of 12, and I sell one for a retail price of 6, then the one that is in ending inventory at the end of the day must have a retail value of 12 minus 6 equals 6. If the good in inventory at the end of the day, ending inventory, has a retail value of 6, and my cost value is 50% of my retail value, my ending inventory at cost must be 3. And finally, my goods available for sale at cost was 6. And if what was not sold today, my ending inventory, has a cost of 3, then the cost of what I sold, cost of goods sold, must be 3. Okay, and so what I just did verbally was walk my way through essentially all of the calculations, and I answered all the questions that I might have asked. In terms of what I did ask, first question, what is that cost to retail percentage? 6 divided by 12, 50%. What is ending inventory retail value? Well, goods available for sale at retail value is 12, minus cash collections of 6 for what I did sell, equals ending inventory at retail of 6 for what I didn't sell. And finally, if the item that is in ending inventory at the end of the day has a retail value of 6, it must have a cost value of 3. And if my goods available for sale overall was 6, and if the goods that I didn't sell had a cost of 3, then the cost of goods that I did sell, 6 minus 3, or 3. The answers for the first 3 questions, 50%, $6, and $3. Okay, any questions about that? Okay, it is a process. The numbers themselves are pretty straightforward arithmetic, and what I tried my best to do was follow the illustration that we went over actually several times in terms of its various permutations. Now, we have a pair of income statements for 2023 and 2024. If I overstate expenses, I understate net income. And if I understate net income, because net income flows into retained earnings, I also understate retained earnings. Furthermore, since retained earnings, the balance in retained earnings is carried forward every year on your general ledger, the retained earnings balance itself will be understated every subsequent year unless something happens to change it. Well, is net income overstated or understated? No, because the only problem we're dealing with is prior year expenses being off, and therefore prior year net income is off. That could carry forward into current year retained earnings, but it doesn't affect revenues or expenses for this year. And therefore, the answer to the fifth question, net income for this year, 2024, is not impacted. Retained earnings, which the question did not ask, would be. Okay, questions about that? Anyone at all? Going once, going twice, and okay, excellent, excellent. So that concludes the quiz. I hope that the quiz was either not a big deal, not very different at all from prior quizzes, or for some of you, helped a whole lot. Those of you who would be helped a whole lot are people who have not very stable or strong internet connections. For those of you, what you were probably doing, what some of you were doing was you were trying to log on to Zoom, get the access code, log off Zoom, log on to Canvas, plug in the access code, take the quiz, log off Canvas, log back to Zoom. And to do all of that in 12 to 14 minutes was unwieldy, especially if you might be in an automobile or on a cell phone as opposed to a laptop, etc. Now, it was a little tricky, for me to basically go to this because what I just described is not the recommended approach for attending an online class. The recommended approach for taking an online class is to find a strong, stable online connection, to have a full personal computer, laptop or desktop, and to open up Canvas and Zoom at the same time, and actually perhaps even McGraw-Hill Connect, the online textbook at that. And so basically, what we're doing is making it easier for people who are not using the preferred approach to attend the class. A little bit controversial, but that is reality. And so we decided to do this. It seems to have worked just fine. Try it again on Thursday next week. And maybe one more time just to be safe, Tuesday. I'm sorry, we'll try it again on Thursday this week. And maybe one more time on Tuesday next week before we can move on to other improvements. Gabe, go right ahead.
Yes, Professor, I have a question regarding the quiz that class we did not have. How will that affect the final grade calculations? I saw on the syllabus there's 24 quizzes and only 20 of them will count towards our grade.
That's exactly right. Now, in opening my calendar, because what I've been doing every time something happens, I update my own calendar to make sure that we have enough sessions so that we can get to 24. And we do. please keep in mind on the very last day of class, the beginning of the class, we will take our 23rd quiz. And then there still has to be a 24th quiz for the material that we'll review the last day of class. But as you can see here, using this technology, I can just make the quiz open maybe over that weekend, the weekend of April 27th and 28th. So we're still going to have 24 quizzes in total. I'm still going to count 20 quizzes. The intention of doing it that way is to allow students to basically to miss 4 quizzes without there being any penalty at all, and we should be able to do it with no problem. Gabriel, was that helpful?
Yes, thank you, Professor.
Sure, sure. Okay. Yajara, go right ahead.
Hi, yes, Professor. If for any reason or for whatever reason there would be other instances later in the semester where we would have to miss class again,
Mhm.
like not because we didn't come to class, but because you had another engagement, how would that work? Like if we wouldn't be able to get to the 24 quizzes.
Right. So basically, what I would do, and by the way, it's possible that that might happen one more time. I don't think it's going to happen more than once, but you never know. So what I usually do is I will assign a light reading. And when I say light, I don't mean inconsequential. What I mean is something that I think is readily graspable by simply reading it or watching a video. And then I might assign a quiz just based on that video. So we'll have a non-meeting activity followed by sort of a freestanding quiz. That's one of 2 approaches. Another approach I can do is I can make the final exam basically a double quiz. And so instead of being 5 questions, it could be 10 questions. I don't like to do that if we're actually taking a quiz sort of during class time, as we usually do. But if the 24th and final quiz, um, will be the weekend after the final day of class, then having a double quiz at that point is usually manageable too. So hopefully we won't have to go there. But if we do, that's the way that we'll handle it. And it usually does work pretty well. Was that helpful?
Yes, Professor. Thank you very much.
Sure, sure. Okay, other questions? Okay, just a few minor final comments about this. Number one, please keep in mind that many people, including people in administration and faculty and students, consider this to be the biggest grind class of the program. Some say it's the most difficult in terms of concepts. I'm not quite sure I agree with that. I think it's just more of a grind. But some people feel that way too. And the fact that I'm teaching this class with no exams whatsoever simply brings a greater degree of observation or oversight down on me. And I welcome it. That's fine. It goes with the territory. But if I seem to be a little bit more careful about checking with people, asking for their feedback, asking if I can do something, and not just going ahead and doing it, it's simply because teaching this class with no exams whatsoever is just unusual, and therefore the oversight is there. There was also an issue, and it affects every class, which is that as long as there is one student in a class that is getting federal student loans of any kind, federal law says you need to take attendance. And I know a lot of classes, there just isn't attendance taken, but federal law says you need to take attendance, which in an online class leads to the question, what exactly is attendance at an online class? And what exactly is an online class? And so this is the answer as of now. which is UH's interpretation of federal law. Number one, in order for this to be a class at which attendance is taken, I need to ask each student, every instructor does, each student needs to do something, take an action, and that action needs to be recorded. And then number two, and this I thought was the more interesting one, in order for it to be a class, a live class, students need to be given the opportunity to interact with the professor, usually by asking a question of some kind. Doesn't mean that I need to force you to ask a question, but I need to give you the opportunity to ask me a question, or else it's not a live class under federal law. The thing that's making this approach unusual, the one that we're taking, is that the attendance is being taken, and your direct activity, which I am measuring, is being taken in one platform, Canvas, but your ability to ask me questions, that need is being satisfied in a different platform, Zoom. And so the question was out there for a while, can we do that? I mean, can I satisfy the two requirements of this being a class if I'm using two different platforms simultaneously to satisfy the two requirements? And so initially, for the first few weeks of the class, I said, well, it's really Zoom because students need to actively log into Zoom to get the access code. And at this point, I have the okay not to worry about that. Still, the need to ask you to do something in an active way that I can observe and record, that's not submitting a quiz answer, because that's being automatically done. It's your logging into the quiz. That is your active activity, which Canvas is recording, which is all that you need to do to be marked present from an attendance perspective. And it's your choice to, and it's our expectation, but ultimately it's also your choice to log into Zoom and take advantage of the opportunity to ask me a question, should you choose to do so. That satisfies the second option. It's okay with me if going forward, you simply go directly into Canvas, take the quiz in Canvas, and then immediately after the end of the quiz, come to Zoom. I'm assuming that those of you with weaker or unstable internet connections will do that. You do have to keep in mind that you'll be unable to ask me questions during the quiz if you're not logged into Zoom. But if that's okay with you, you satisfy all federal requirements by going to Canvas first, taking the quiz, and then coming over to Zoom. And that concludes my review of what we just did and why we just did it. Again, I'll try it one or two more times before I declare victory. The next step, by the way, I wanted to get this done, get this fixed, if you will. The next step, which I hope to take right after we come back from spring break, is to see about recording the sessions so that you can watch thereafter what it is that we do together without actually attending. Because remember, I just have to give you the opportunity to attend and ask questions. I don't actually have to force you to attend on Zoom and ask questions. Phew. But to record each of the class sessions is the next thing I want to focus on. And if I can do that, then it's possible, and it might be helpful, if I record like a little introduction, like a pre-video, that would be sort of an introduction to the textbook, for each chapter. Just thinking about that right now, but that's next on my to-do list. Okay, questions at all about the administrative issues? Okay, so without further ado, I shall share screen. And then we'll hop directly into chapter 10. Okay, so sharing screen. We open up. Oops. I'm going to try today to get through as much of Part A as I can. Part A actually is where the heavier information is, although in all honesty, Chapter 10 I think is a little bit on the light side. Chapter 11 gets more serious. That's PP&E Part 2. This is all about PP&E, which is property, plant, and equipment, as well as intangible assets. Another way of referring to this chapter, they are long-term assets. You don't expect to get rid of them within 1 year. You expect to hold on to them for a while. Receivables, accounts receivable, usually you try to collect them within a year, then they go away. Inventory, usually you try to sell it within a year. Office supplies, you try to use it within a year. Idle cash on hand, you're hopefully spending it or investing it within the year. And so most of the assets, other than these, are considered short-term assets. You expect to use them up, or in the case of cash, spend them within a year. Long-term assets, you expect not to use them up within the year. You're going to have them for more than 1 year. Now, Part A asks the question, it's the basic accounting question, what is the value of different kinds of long-term assets? So we'll go to 10-3. So bottom of this page, there we go. Okay, what the textbook authors do, what the author does is list pretty much every imaginable type of long-term asset there is. And I won't go through each and every one of these. I think most of these are pretty self-explanatory. What are long-term assets in general? Well, you have long-term assets that are tangible, they are physical, you can touch them, property such as land, plant, those are basically buildings, and equipment. You usually see furniture listed in these tangible assets too. And then you have intangible assets, things that are not physical, but you expect to have them for more than a year, and they are valuable. Intellectual property, in other words, is an intangible asset. Now, PP&E, property, plant, and equipment, derives their value from long-term use in operations rather than from resale. In other words, if you're going to invest in something simply to resell it, to flip it, and make money, then it actually is inventory. So if you're buying a house to flip it and make a quick profit, that is not property, plant, and equipment. On the other hand, if you're buying a building to work in, You're not selling the building, you're going to work in it. That is property, plant, and equipment. Okay, now what I'm going to do, I'm going to run down, and again, I won't go through every word, but I'll run down the descriptions, and then I'll jump over to the right column and talk about the valuation costs. Equipment is exactly what you think it would mean. Land basically is real estate, or what the textbook author calls real property. Please note, if you're buying anything, including land, because you expect to flip it for a quick profit, it is not PP&E, it is an investment. Yeah, that's what I just mentioned. Land improvements are part of the value of the land. So if you pave a parking lot and you look at that pavement, the gravel or the concrete, and you say, well, it's part of the land, or is it? When does the land stop and separate pieces of property or equipment that are on the land begin? Well, pavements to parking lots, driveways, roads, etc., is classified as a land improvement. Fences, landscaping, and sprinkler systems, also land improvement. We don't call them land. We don't call them, like sprinkler systems, we don't call them equipment. We call them land improvement. Buildings are what you think they would be. Natural resources. So if I own trees and I'm going to cut them down to make timber, if I have minerals, if I own a mining operation and I'm going to mine valuable minerals and use them, if I have oil and gas underground as an energy company, those are natural resources. They are tangible, they are assets. If I'm going to use them in my own operations, they are fixed assets. If I'm going to use them only to sell them, then they are inventory or investments. Timber. Some companies own their own forest land and they cut down the trees and they turn the trees into paper. Well, they ultimately sell the paper, but they're not selling the trees. And so the trees would be a natural resource. They would be a long-term asset. On the other hand, if I'm a Christmas tree farm and I'm cutting down the Christmas trees and selling them as Christmas trees, then those trees, when they're still in the land, would be investments in inventory. Any questions about that? A little bit tricky, just a little bit tricky. Intellectual property or intangible assets. Well, if I produce a creative work, a song, a film, a book, etc., then my intellectual property rights are called copyrights. If I have a slogan or a logo, then my intellectual property rights are called trademarks. And if I have invented some kind of manufacturing product and it's the right to use the product or the knowledge in how to manufacture it, it's the same intellectual property concept, but we call that a patent. What's a franchise? The easiest way to think about it is just think about McDonald's. If you're a McDonald's franchisee, then McDonald's is making you pay McDonald's for the right to run a McDonald's in a certain geographic area. That's a right that you have. You cannot touch the right which makes it an intangible asset, but it is an asset because it has value. Okay, software development costs. Basically, the software itself. If you create software, technically speaking, you could get a patent on the code or the language. But what the textbook author does is differentiate between a patent on something that is being manufactured versus what is essentially a patent on what is being coded. If you buy someone else's patent, then you are acquiring their intellectual property. So that counts as an intangible asset. And goodwill is basically brand value or reputational value, unique value of the company, over and above all other identifiable assets. Why did you spend $100 million for this company when the value of all the assets that I can identify is only worth 90 million? Because they just have $10 million worth of a good reputation, goodwill. Okay, questions about the description column? Okay. To go through the acquisition cost column, the important thing to remember is the definition for tangible assets, which I just highlighted, and the definition for intangible assets, which I just highlighted, exactly the same definition. It's everything that you have to spend to get the asset purchased and ready to be used. So if you're running a coffee bar, and if someone just sold you a really expensive espresso machine, and if you're paying a large amount of money for the espresso machine, but you need to set it up and to have the vendor show you how to use it. And so you pay an additional fee for the vendor to come to your coffee bar, set it up, and show you how to use it. Then the cost of the asset is not just the cost of purchasing the physical equipment, it's the cost of getting someone to come in, set the machine up, and show you how to use it. Okay, that's what we mean by that. What are all the different expenditures that you have to make to get equipment not only purchased, but ready to be used? Well, you might have to pay sales tax. You might have to pay for shipping. You might have to pay someone to install it. You might have to pay someone else to test it to make sure that it works. You might have to pay someone else to take it on a trial run. That might be a luxury automobile, etc. What about land? If you've ever purchased land or a building, like a residential home, you think that you know how much you're going to spend. But whether you're buying land or a home for yourself, the fees and expenses and charges just add up and add up and add up. Okay, bouncing a little further down, as you can see, the rest of the column basically says the same thing. For software IP, intellectual property, it's costs after you know the software might work, but before you actually sell it or release it. Those are the costs of creating the software. Why not costs incurred before you know it will work? Well, if any of you do any software programming, you know for every software program that makes its way to market because it works, there are a million different software programs that people try to write, which never, ever, ever, ever work. They're simply not feasible. And so the accounting standards say, hey, look, if you're spending money to develop software, once you know it's going to work, hopefully, feasibly, those costs are part of the cost of the asset. Anything that you spend before that time is just sort of kidding around time, general playing around, general experimentation. Now, why are costs to develop software after product release, after the goods are sold, not be part of the cost of the software? Because you've already released the product, you've already sold it. And as a result, we have that cost definition that looks a little restrictive at first glance, but it's actually not too bad. Okay, and finally, as I mentioned, for goodwill, if you identify all the different assets that you are purchasing when you buy a company, and if you say, all those assets I think are worth $90 million, but you decide to spend $100 million for the company, why did you pay the extra 10 million? It's not always, but often because of the company's strong reputation, their brand value, their goodwill. Now, at the end of this illustration, they just list a whole bunch of miscellaneous other types of intangible assets. And the author correctly notes, for anything else, it's basically, well, actually, all he does is just repeat that same definition over and over again. Okay, it's probably one of the lengthiest illustrations I've seen in this textbook, but I think it's still relatively straightforward. Any questions about it? Okay. Next up, 10-4. -4, pretty easy. I am going to buy a piece of equipment. I spend $62,000 for it. I have to pay someone to ship it to me. That costs an extra $1,000. I have to pay to insure it because it might get damaged during shipping. It's going to cost me an extra $300. I might have to buy a separate special platform that will sit underneath it. It's like having to buy a computer desk to go along with your computer. That costs money. And I have to test the equipment before I can use it. Trial runs. That costs money too. Do these all factor into and get added to the purchase price of the equipment? Absolutely. What is the test? Was it necessary to spend all of these different tasks, spend money on these tasks so that I could start to use it? And in this case, the answer is yes. However, if you were to see an extra cost item that said, this wasn't really needed to bring the equipment to me so I can use it, it was just something I felt would be nice. For such expenditures, they would not go into the cost of the equipment. And if you're thinking, well, it would just be nice, and you're paying for them, you would reduce cash and you would recognize an expense. Okay, questions about illustration 10-4? Okay. 10-5. Now, honestly, what the textbook author does at this point and through the remainder of the chapter, he's really just going back to the same issue. And the issue is pretty straightforward, but he makes the questions, the details of the questions more complicated. So at this point, for much of this, he's not introducing any new concepts. He's just messing around a bit in terms of how he presents the information to you. And so here you're buying land. You spend, and I'll use my highlighter, my cursor highlighter, to basically bounce back and forth. Here's where the textbook author says you pay $500,000 for the land. Okay. Here's where we add that into the cost of the asset value. You also have to spend fees. And remember, without paying these fees, you cannot get the land. As a result, if you need to spend the 3,000, the 16,000, and the 4,000 to get the land, then the 3,000, 16,000, and 4,000 are added to the cost of the land, the value of the land. Then he goes on, tricky, and he says, by the way, once you buy the land, then for the first year that you own the land, that's what he means by current year taxes, you'll have to pay $2,000. See, this is after you buy the land, after the purchase date. You'll have to spend $2,000 on taxes. Well, if that's what you will spend after you buy it, it can't be part of the cost when purchased. It's a subsequent cost. And that's why you don't see $2,000 listed here below. Okay, where'd the $10,000 come from? Well, to prepare the land that you're buying so that you can use it, you have some preparation costs. The textbook author could have just listed $10,000 here on his little table, but I guess he figures it's more confusing to take some of the costs that you would expect to be on that little table on top and list it differently. And so here's an additional cost to get the land ready so that you can use it. And then here's yet another additional cost to prepare what you are buying so that you can use it. Well, if you need to spend the money so that you can use what you are buying, it is added to the cost. That's why the 10 and the 5 are added there. Okay, questions about illustration 10.5? Okay, again, complications and how he chooses to present information, no different conceptually than the previous illustration. Now 10.6, capitalized costs of natural resources. Okay, what's happening here? I am buying the right to explore for copper. Now, actually, you see a lot of this happening in Houston, except it's not copper that companies are looking for. It's the right to explore for oil and gas. Same idea, though. I am spending a certain amount of money, $1 million, for the right to explore for oil and gas. To begin with, what I am buying is valued at $1 million. Wait. To get what I want to explore into a position so that I can actually explore it, I have to spend another 800 and another 500. And so you add 800 and 500 to the list of costs that you must expend in order to use the property, which is meant to be explored. And then the textbook author gets cute. And he gets cute. Well, actually, cute is a positive word. I could just as easily say he gets ugly. So, no, not personally, but in terms of the problem. He does two things. He says, okay, number one, I'm going to have a cost item. You have to spend this money in order to use the property. But you're not going to spend the money right away. You're going to spend the money after a period of time. Well, if that's the case, if you're committing to spend money and you're committing up front, but the cost will only be borne in the future, but you have to commit to it up front. You're signing a contract, right? A bond that says, I will spend this money. I have set the money aside. It is a cost. If you're not quite sure whether it will actually cost you 500 or 600 or 700, but you're 30% sure it'll be 500, but you are 50% sure it'll be 600, and you're 20% sure it will be 700. It's going to be one of the three. You're just not sure which of the three. Then you don't have a single cost number to add to your cost list to be capitalized. You have a weighted average of the cost numbers, which is 590. Okay, that's the first ugly part of this. The second ugly part is you're not going to have to spend it until sometime in the future. And therefore, the cost today of this future expenditure is the present value of 590, which is 468,360. And by the way, I won't actually ask you to compute the present value on a quiz, but using much simpler numbers, I might ask you to compute and to know why you are computing this weighted average, the 590. And then I might simply tell you, and the present value of that number is this. Okay, bottom line is, it's the same concept. I mean, there's no change here. You know, you have to spend a certain amount of money above and beyond simply buying the item, buying the asset, to get it into a position where you can actually use the asset. Federal government says, hey, I'm the federal government. Unless you put money aside to restore this land to its original purpose, well, restore the land to what it originally looked like after you're done mining, then if you don't put that cash aside up front, under regulation, I'm not going to let you explore. And so, because the cash needs to be put aside up front, it is a cost of acquiring the asset and getting ready for its use. If you don't know exactly what that cost will be, then the cost is a weighted average, not a number that you know with certainty. And if the dollar amount needs to be put aside, but you won't actually give it to the party until a point in the future, then the cost is a present value of that future payment. Okay, Andrew, I saw you raise a hand, but then you lowered it. Did I answer your question along the way?
Yes, you did. Thank you.
Sure. Okay, so what is to the equipment cost or the property cost, well, it's 2,768,360. Debit property, plant, and equipment, top of mind, for 2,768,360. Most of that cost you're spending up front, 2.3 million. The portion of that cost that you're not actually spending immediately, but you will in the future, you've committed to spending it, 468,360, that would be a liability because you're not spending the cash yet. You intend to spend the cash in the future. Has the value of the firm changed? Is there any revenues or expenses? Well, if one asset goes up by 2.7 million and another asset goes down by 2.3 million, then assets overall have gone up by 468,360. Assets have gone up by the difference between these two numbers. Liabilities have also gone up by 468,360. And so if assets and liabilities have gone up by the same amount, assets minus liabilities, or the value of the company has not changed. No revenues, no expenses. And then at the very, very, very last second, somewhere here we go. See, what the textbook author does is say, let me just bury this in the middle of a paragraph. Maybe you won't notice it. Now, if I was in the mood to do an evil laugh, I would do an evil laugh. Maybe I should have sound effects, but that's what the textbook author is doing. If I bury yet another cost in the middle of the paragraph, maybe you won't notice it. Why is that so evil? Because this cost has nothing to do with the value of the natural resources. It's just some equipment. Okay? And the equipment costs you 600,000. And so after recording this top journal entry, which is what the illustration is all about, sure, if you go out and spend another 600,000 to buy some equipment, you would increase equipment and decrease cash by 600. On the other hand, that journal entry, that last one, this one, is basically what you learn to do in Accounting 2301. Has nothing to do with the subject matter. Okay, questions. Okay. I hope you're agreeing with me. You know, there's nothing in this entire course that's super simple, but it is much more straightforward, I think, than some of the other stuff that we've covered in the past. Goodwill, 10-8. I don't remember if I've mentioned this to you in a previous class as a class, or I've just mentioned this to you in sort of conversations, sort of the after class conversations. But I do talk to students who began as accounting majors. Some of them bounced to finance majors, and eventually they wind up in places like marketing majors. And then when they become a marketing major and they go out and work in the real world, they see something like this and they say, oh my God, this is accounting again. But I decided that I didn't want to be an accounting major, which is why I majored in marketing. And I have to break it to them and say, you know, I'm sorry, but accounting is everywhere. Maybe that was an opportunity to do an evil laugh again. But accounting is everywhere. And furthermore, accounting is not just something that you will encounter as a marketing major. Accounting itself is the primary way in which your company will define how well or how poorly you're doing your work in the marketing department of this company. Because goodwill, the value of goodwill is the value of your brand, right? Goodwill means how consumers think of you. And so here, now I gave simpler numbers, but here's simpler numbers. I am buying some other company. The other company has assets, $250 million worth. Well, for the sake of simplicity, let me just say 250. Okay. Company says to me, however, hey, if you're going to buy the assets of this company, you also have to pay the liabilities of this company. Okay, well, if I have to buy the assets and the liabilities of a company, because I'm buying the company, then I'm buying the assets that are worth 250. That's good news. And I'm not willingly, but grudgingly agreeing to buy the liabilities of the company, which means I then have to pay them. So that's 120. Well, if I am acquiring 250 of assets and 120 of liabilities, the value of the overall company I'm acquiring is 250 minus 120 equals 130. Let's say I actually agree to pay the owners of the company 180. Well, then the question is, why am I paying 180 for a company that's only worth 130? Well, there could be many different reasons, and many of them have nothing to do with goodwill. And if they don't have anything to do with goodwill, then what I am about to say is not relevant. And so someone might say, well, I really should only be spending 130, but if I don't buy this company, my competitor will. And as a result, I am overpaying to keep this company out of my competitor's hands. I don't think of it as I'm buying something that's really worth 180. I think of it as I am overspending by 50 so that my competitor can't use it. Well, that would be an example of overpaying by 50 for a reason that has nothing to do with goodwill. And therefore, this illustration would not apply. What if you say, however, I'm actually buying it because customers think well of the company. There is positive brand value in the company. And that brand value is worth 50. And frankly, what that really means is if I'm buying these 4 assets, which I have identified on this little list, and if the 4 assets that I've identified are worth 250, and if I happen to think that the company also owns, in a way, $50 million of goodwill, then really I'm buying assets that are worth 300, not 250. And if I'm buying assets that are worth 300, not 250, and I'm also assuming liabilities that are, I'm going to have to pay 120, well, then 300 minus 120 is what I will spend to buy this company. It's 180. It also means that when you record the purchase of the company, okay, you are debiting all the identifiable assets that you have purchased. You are crediting the liabilities that you are going to assume and pay. You are crediting what you are spending to buy everything, cash. Does it make sense that to make the journal entry balance, you have to debit something for 50? Yes. That is the additional asset that you are buying. You are buying the company's goodwill. Goodwill is, in a mathematical or arithmetic sense, measured. The 50 is calculated by adding up the identifiable net asset value, which in this problem is 250. Then, well, I'm sorry, let me start again. The identifiable gross assets are 250. The identifiable liabilities are 120. Thus, the identifiable assets net of liabilities, that's what the textbook author means by identifiable net assets, assets minus liabilities, 250 minus 120, or 130. And what I actually pay, which is 180, in excess of the identifiable assets minus liabilities, what the textbook author calls the identifiable net assets of 130, is goodwill. It's a backwards way of thinking about it, in my opinion, because you're sort of backing into what the goodwill number is. In reality, though, you're buying total assets of 300, including goodwill. You're assuming and will pay total liabilities of 180. Assets in total, including goodwill received, 300, minus liabilities received of 120 equals amount paid, 180. That's the way that I usually approach this kind of problem. Okay, questions about that? Okay, I am inclined, now that we appear to have 9 minutes left, not to go into illustration 10-9. I can hold that until Thursday. Lawson, go right ahead.
I just wanted to ask, how do you calculate goodwill again?
Okay, so goodwill is equal to, well, goodwill is an asset that you purchase. And if the assets that you have initially identified as assets that you're going to purchase, 250, minus liabilities that you have agreed to pay, you're going to assume them of 120. If the 250 minus the 120 is less than what you are actually paying, which in this problem is 180, then you have to ask the question, are you seemingly overpaying just to keep the property out of a competitor's hands? Or maybe you just have bad information and you are overestimating what it's worth. In that case, there is no goodwill. On the other hand, are you seemingly overpaying at first glance because the company that you're buying actually has an asset called goodwill, and they've never bothered to measure it before? It's just something that has developed over time. But it is an asset. It has value to you, and therefore it exists. That's the logic of how you compute goodwill. And basically what the author did here was try to turn that process into a verbal description of a formula. But it's really a process that you have to think through to get at whether goodwill is really there at all. And if so, how much could it be worth? Was that helpful?
Yes, I see the how we got to the 50 from the 180 and the 130.
Yeah, and he sort of, and that little footnote at the bottom is a way of backing into a single formula. And a lot of authors do that because you have people taking accounting, and the way they take accounting is everything must be reducible to a formula that you can plug into an Excel spreadsheet. That works if the process by which you come up with the number is formulaic. This is a lot more conceptual, and therefore this formulaic approach of defining goodwill is a little bit clunky. Okay, other questions? Okay, so looking forward to next time. First, let me yellow highlight. Oh, hold on. Let me yellow highlight what will be on the quiz on Thursday. And I'll have to work on my yellow highlight because that was text color and not highlight color. As you can see, I'm using a different program at the moment. So I'll figure that out very shortly. But these are the illustrations that we will cover for the next quiz. Please do let me know if you feel strongly one way or the other about the modifications that we just made to the quiz taking technique. I am going under the assumption that the majority of you, it won't make a difference one way or the other, but there are a good number of you that will be much less inconvenienced by taking this approach. And again, once we come back from break, the next thing that I'm going to try to institute is to come up with an approach to record what it is that we're doing for your later viewing. And with that, I'll stick around after class for individual questions, but let me call a last call. Any class questions? Going once, going twice. And okay, guys, we are ending the class with 4 minutes to go.